Okay, so let's unpack this. I mean, for the last few years, if you've been watching the world of retail finance and, specifically the platforms that have really pulled in younger investors, the biggest promise has been continuous access.
Right, the 24-hour market.
Exactly. The idea is, well, it's pretty simple. The stock market, this huge engine of wealth, is finally getting rid of its old, kind of antiquated 9 to 5 hours. It's moving into the modern world.
It's an incredibly powerful piece of psychological marketing, really, because it taps directly into what we all expect now, which is immediacy.
Everything on demand.
Everything on demand. Why should you have to wait until 9:30 in the morning in New York to act on some news that broke in, say, Shanghai at 1:00 a.m.? The idea that you can trade Nvidia or Tesla literally any time of day, it promises empowerment. It promises an edge.
And this is the absolute core of our deep dive today. This is the reality check. That trade you think you're making at 2 o'clock in the morning, it is not happening on the New York Stock Exchange.
Not even close.
It's not happening on the NASDAQ. And if you believe you're using the same ironclad infrastructure, the same deep pools of liquidity, and the same regulatory protections that govern the official U.S. markets, you're really operating under a pretty profound illusion.
And that's where we get to the core mechanism that our source material really highlights. What these services do, the ones popularized by the big retail brokerages, is a process they call sideloading.
Sideloading.
They're essentially creating a parallel, totally private pool for trading that, it mimics the real market, but it runs completely on its own. So we're really looking at a simulated market.
A simulation.
And it functions under completely different rules, different physical limitations, and this is the most important part, different laws than the regulated real market.
And that difference, that gap between the simulation and the reality, is what introduces this concept that the research calls the time machine risk.
The time machine risk is, I think, the most chilling takeaway from all this. It's the specific contractual and regulatory ability for these private venues to retroactively cancel or bust thousands of trades.
Hours after they happen.
Hours after you thought you were done. Imagine having the power to just turn back the clock for your own benefit, just erasing the history for everybody who thought they had a final, completed trade.
We're going to anchor this whole discussion in a very specific real-world failure because it just perfectly exposed all these faults. The infrastructure collapse of the Blue Ocean Alternative Trading System, or ATS, back on August 5, 2024.
And understanding the architecture of these ATS venues and where their weak points are is just so critical for anyone using these always-on platforms. Because when these systems get stressed, when real panic hits, the rules of the game change in a flash.
And the user suddenly finds out that the guarantee they thought they had just dissolves.
It dissolves the exact moment they need it the most. We really need to look at how the plumbing of the financial world is split into these two very, very different theaters of operation.
So, okay, let's peel back that curtain. Let's get into the actual infrastructure, the mechanics of this side-loading architecture. Because when we hear 24-hour trading, I think most people imagine Wall Street just decided to keep the lights on all night.
Right, like a massive centralized shift.
Yeah, but you're saying the reality is it's more of a workaround.
That's the perfect way to describe it. It's a workaround. It's technology trying to get ahead of, let's say, regulatory inertia. So Robinhood or any of the big brokers, they aren't suddenly launching their own global stock exchanges that run nonstop.
So what happens then when you place that overnight order?
The order gets routed. It goes to a third-party private venue. And in this specific critical case for U.S. stocks, that destination is very often Blue Ocean ATS.
Okay, so let's walk through it. It's 3:00 a.m., I can't sleep, and I decide I need to buy a share of Nvidia. It feels instant on my phone, but what's the actual journey my order is taking?
Okay, so your order immediately enters the Blue Ocean system. You can think of it like a walled garden or a private matching engine. So step one is the internal match.
Internal, meaning only inside their system.
Only inside their system. Your buy order is matched exclusively within Blue Ocean's specific pool of orders. Now, this can be against another retail user who happens to be selling at that exact moment, or, and this is far more common, it's matched against a designated liquidity provider.
And that's where the big institutional players come in.
Precisely. To make sure there's any liquidity at all in the middle of the night, these ATS pools rely heavily on major market-making firms.
Like Jane Street.
Like Jane Street, who the source material mentions as a key player here. Their job is basically to stand there, ready to buy or sell, and they make a tiny bit of money on the spread. Without them, that overnight pool would just, well, it would dry up instantly.
Okay, so I hit buy, Jane Street or another user takes the other side, and my phone flashes green. Trade executed. That's step 2, right?
Yeah.
The private ledger.
Correct. The trade gets recorded on Blue Ocean's internal books. It's on their proprietary ledger.
Oh.
But, and this is the single most important detail that separates the simulation from reality, the trade is not immediately printed to the consolidated public tape.
And the tape, that's the official scoreboard for the entire U.S. market, right? The SIP?
Exactly. The SIP, the Securities Information Processor, it's the official fire hose of all public trades and, quotes, mandated by regulators. It aggregates everything from the NYSE, from NASDAQ, all the public exchanges.
And it's closed.
It's closed. It shuts down in the late afternoon and doesn't reopen until the pre-market session starts, usually around 8:00 a.m. Eastern. So that trade you made at 3:00 a.m., no matter how real it feels on your phone, it only exists in Blue Ocean's private universe. To the rest of the regulated market, it's invisible.
Which brings us to the core problem. Delayed settlement. I see the cash, leave my account on the app, I see the share appear, but legally, the deal isn't actually done.
You've just hit on the structural limitation that this whole system is built around. The official U.S. system, even as it moves towards T+1 settlement.
Trade day plus 1 day.
Right. It still requires a full clearing cycle to finalize everything. So that 3:00 a.m. trade is legally defined as a pending contract. It's basically an IOU, a commitment to finalize the trade later.
And why is that clearing process so vital? Why can't Blue Ocean just say, nope, it's final right now?
Because finality means integrating that trade into this massive chain of risk management, regulatory oversight, and legal transfer of ownership. That whole process is governed by huge clearinghouses like the DTC.
The Depository Trust and Clearing Corporation.
Right. They process trillions of dollars every single day. So your little 3:00 a.m. trade has to wait for that official T+1 settlement cycle to kick off the next business day. Only then can it be cleared, finalized, and actually integrated into the real financial system. Blue Ocean has executed the match, but they haven't executed the settlement.
And that delay, that's the window.
That is the critical legal window where the time machine risk can come into play.
So this whole architecture, being walled off, limited counterparties, it creates what the paper calls the price island.
And what's fascinating here is how you get this divergence of reality. Normally, the price of a stock is constantly being tested by liquidity from everywhere, all the exchanges, all feeding into the SIP. But when you take that away,
You're on your own.
you're on your own. The price of a stock on Blue Ocean is determined only by the limited private order book inside that one pool. It becomes an island completely cut off from the mainland of, true price discovery.
So if the only people buying and selling in that garden at 3 a.m. are one big market maker and a few night owls, that price is incredibly fragile.
Incredibly. Let's make it concrete. During the day, NVIDIA might be at $100, and the order book shows, say, $50 million worth of bids and asks within a few pennies of that price.
Right, it's deep.
It's super deep. But on the price island at 3 a.m., you might only see $100,000 worth of bids near that same $100 price. That tiny pool dictates what they call the side-loaded price. Meanwhile, the true value of the company, its real net asset value, is kind of frozen until 9:30 a.m. when the main market wakes up.
And that's separation. That's the fault line.
That is the systemic fault line. And when a real-world panic hits the simulation just cannot hold.
Okay, so let's talk about the moment that fault line didn't just crack, it shattered. We're moving to the case study that takes this all from theory into, well, a terrifying reality for the average person. The August 5, 2024 collapse.
This was a textbook stress test. The trigger was a huge, sudden crash in the Japanese Nikkei 225 index. When a major global market drops that hard, that fast, the fear just ripples.
It's contagious.
Instantly. It creates this global urgency to de-risk, to get out of positions.
Because everyone had been sold this promise of 24-hour trading, they felt like they couldn't afford to wait 6 or 7 hours for the U.S. market to open. They rushed to their apps.
Right. At around 2:00 a.m. Eastern Time, they flooded Robinhood and other platforms to try and sell, to get out of their stocks.
And the system couldn't handle it.
That volume was the tipping point. The ATS infrastructure was built for, regular, low-volume overnight trading. It was never designed to handle an instantaneous, massive wave of coordinated global panic selling.
It just seized up.
It seized up. The Blue Ocean ATS couldn't process the orders. You had massive latency. People couldn't connect. And ultimately, the system just failed under the sheer pressure of the volume.
And this is what kicks off the time machine event. This is the timeline that is so important to understand because it starts with this moment where the user feels completely safe.
Absolutely. You have to put yourself in their shoes. It's 3 a.m. They're frantically hitting sell. They're watching the price drop, but they get their trade through. They get a confirmation.
The green check mark.
The green check mark. They see their stock balance go to zero, and they see a cash balance appear on their screen. In their mind, they've done it. They used the 24-hour market exactly as intended. They saved their portfolio from a crash that was still unfolding in Asia.
They can breathe again. Maybe go back to sleep.
They feel secure. They believe they are holding cash. And that is the critical 4-hour window of false confidence. They thought they beat the clock.
They did for a while.
For a while. That belief lasted until 7:00 a.m. Eastern. 4 hours after those panic sales went through, the official announcement came down. Blue Ocean and its partner brokers, they put out the notice.
And what did it say?
It said that due to overwhelming system failure, the trades that were executed during that crash window, we're talking tens of thousands of trades between roughly 2 a.m. and 3:30 a.m., were being retroactively canceled.
Rusted.
Busted. The history was just erased.
And the implication for the user is just, it's brutal.
It's genuinely brutal. Those investors who went to sleep thinking they were safe, holding cash, they wake up a few hours later, maybe closer to the 9:30 a.m. market open, and they find their cash balances gone.
And the stock is back.
They were forcibly put back into their plummeting stock positions. Their confirmed sale was suddenly invalid.
So they were holding the very assets they thought they had just escaped from. And at that point, they're completely trapped.
Utterly trapped. The Blue Ocean system was still unstable. You couldn't trade on it. And the main exchanges were still hours from opening. So they had no choice but to ride it all the way down until the NYSE and NASDAQ opened at 9:30 a.m.
And much, much lower prices than they thought they'd sold at.
Far lower. This event just demonstrated it so clearly, so destructively. The core risk is this. In a side-loaded market, trade execution is not final. It is conditional. It's conditional on the fine print in a contract and, well, stability of a private company's server.
So this is the big puzzle, right? The legal and the structural question. We've established trades were confirmed, balances changed, and then 4 hours later, poof, they're gone. How can a marketplace just erase transactions? On Wall Street, canceling a trade is practically financial heresy. How do they get to undo the past?
It all comes down to a single fundamental concept.
Yep.
Regulatory asymmetry.
Asymmetry.
Yeah. The legal structure that governs an ATS like Blue Ocean is completely different from the one that protects you on the NYSE or the NASDAQ. And that difference is the key that unlocks the time machine.
Okay, so let's establish the baseline first.
Yeah.
What are the rules on the big national exchanges that protect trades?
The national exchanges, so that NYSE, NASDAQ, CBOE, they are very strictly governed by the SEC. And trades on those platforms can only be busted or canceled under extremely specific and restrictive rules. They're called Clearly Erroneous Execution Rules, or CEE.
And the bar for what counts as clearly erroneous has to be incredibly high, I imagine.
Unbelievably high. The whole system is designed around the idea that the finality of a trade, the integrity of that execution, is absolutely paramount for market trust. So, to invoke CEE, you have to prove the trade price was so wildly out of line with fair market value that it was obviously a mistake.
Like a fat finger trade.
A fat finger trade, a computer glitch that causes a $100 stock to trade for a penny or for $50,000. It's a safety net for genuine errors, not a tool for cleaning up a messy situation or because you regret a trade.
So if I sold a stock at 3:00 p.m. on the NYSE for $98, and then 5 minutes later some great news comes out and it jumps to 105,
Yeah.
I can't call them up and say, hey, can I have a do-over?
Absolutely not. Your panic, your bad timing, even a sudden market shock, that's just considered normal trading risk.
Yeah.
The system is built to protect the integrity of the execution itself, even if the price turned out to be bad for you. That is what finality means in the official market system.
Okay, so now contrast that ironclad system with the ATS model.
Right. And here's the asymmetry. These alternative trading systems, they are not full-blown national exchanges. They operate under a, let's call it a lighter touch regulatory regime. And crucially, the relationship with you, the retail investor, is governed mostly by private subscriber agreements.
That wall of text you scroll through and click, I agree to.
That's the one, the fine print. The contractual language in that document becomes the primary tool, and it basically supersedes the strict CEE rules that protect you elsewhere.
And that's where the time machine clauses are hidden.
Exactly. These agreements almost always contain specific protective clauses. The big ones are force majeure, or even more specifically, system failure clauses. A force majeure clause usually covers things you can't control: a hurricane, a war, an act of God.
But a system failure clause, that sounds like it covers their own tech.
It does. The language in the contract often covers things like unforeseen technical demands, failure of connectivity, system overload exceeding operational capacity. Stuff that basically treats a massive server crash from panic selling, which is totally foreseeable in finance, as some extraordinary event that justifies voiding all the trades.
So the ATS operator can just point to that clause, claim their system failure was an extraordinary event, and wipe the slate clean.
That's the mechanism. It's that simple. It gives them broad contractual discretion to just void everything if their own technology can't handle the stress. The danger of the structure is that the regulatory framework allows them to do it.
And in doing so, they successfully shift all of the technological risk away from themselves and directly onto the retail user.
Every last bit of it. The user believed they were executing a final trade, but the finality was only ever conditional.
So when you connect all these dots, this fragile infrastructure, the thin liquidity, the conditional finality, this contractual rewind button, it becomes really clear that the risks are much bigger than just one user who got burned. These are systemic.
Oh, they absolutely are. This simulation isn't some small sandbox anymore. It's a massive, growing pool of retail money and, frankly, emotional trading. And our source material really breaks this down into three major interconnected systemic risks.
Let's start with the first one, which is this idea of the phantom liquidity trap.
So the trap here is this immediate and often catastrophic disconnect between the price you see on the screen and the amount of stock you can actually trade at that price.
The displayed price versus the accessible liquidity.
Exactly. You open your app at 2 a.m., you see NVIDIA is trading at $100, and you just assume that price is solid. You assume you can sell maybe 500 shares, $50,000 worth at or very near that price. That's what a liquid market means.
But the reality on that price island is completely different.
Catastrophically different. As we said, the overnight order book is thin. So during the day, the market depth might be millions of dollars, just a penny away from the current price. But at 3 a.m. on Blue Ocean, the depth might only be a few $1,000s. So if you try to dump that $50,000 sell order,
There's nobody there to buy it.
not at that price. There might only be bids for $2,000 worth of stock near $100. So the rest of your order has to smash the price down just to find the next buyer.
You end up getting filled at $99.50, then $99, then $98.50.
And your one moderate-sized sell order has just disproportionately crashed the side-loaded price. That's the first danger. The phantom liquidity vanishes the second you actually try to touch it.
And what happens when the big institutional players, the Jane Streets of the world who are providing that thin liquidity, what happens when they sense that volatility?
That is the absolute worst-case scenario. Their job is risk management. So if they see a sudden, huge wave of panic selling, they are allowed contractually and systematically to just pull their bids instantly.
So the market just disappears.
Yeah, it evaporates. You will see a price on your screen, say $95, but there will be zero bids. You cannot sell a single share at any price. The market becomes completely inaccessible, even if a price is still technically being displayed, and that just creates these horrible panic spirals all contained within that one little price island.
Which leads right into the second risk, which I have to say is genuinely fascinating: information asymmetry and surveillance.
Yeah.
Here's where it gets really interesting, because this is about how the sophisticated algorithms use the retail panic against the retail traders themselves.
This is the classic smart money risk. High-frequency trading firms, HFTs, they thrive on having an information advantage. So, of course, they subscribe to the Blue Ocean trading feed. Now, the trade itself might be conditional and might get busted later, but the data from the order flow,
The data is real.
the data is pure gold. The velocity of sell orders, the size, the sheer imbalance of sell pressure, that is unfiltered retail sentiment.
So the ATS feed becomes a sentiment sensor for the pros.
It's a perfect sentiment sensor. If an HFT firm is watching thousands of retail accounts panic sell Tesla at 3:00 a.m., they know two things for sure. One, the retail herd is terrified. And two, all those people who just got their sales busted are going to try to sell again the instant the real market opens.
So they're using the panic in the simulation to get ready to profit in the reality a few hours later.
Yeah.
But how do they actually front-run it? They can't trade the stock yet.
They don't need to. They use related instruments that are trading 24 hours a day, like index futures, or they just get their algorithms primed for the open. So for instance, if they see massive selling in the 10 biggest tech stocks on the ATS, they can immediately go and short the relevant E-mini futures contract that trades globally overnight.
So they lock in a position based on the certainty of what's coming.
It's a near risk-free informational edge. They are watching the order flow, the price collapse, and they are positioning their capital to profit from the predictable, delayed actions of the retail crowd when that opening bell rings at 9:30 a.m. The simulation, even if it gets erased, provided the intelligence they needed to crush the participants in the real market.
And that brings us to the third risk, the tail wagging the dog, which is how this phantom activity can actually start to dictate real-world outcomes.
Yeah, this really brings it full circle. Traditionally, the tone for the market was set by professionals, global index futures, currency markets, big trading desks in London and Hong Kong. That was the sophisticated tale that guided the big U.S. stock market dog in the morning.
But now you have this huge pool of unrestricted, often emotional retail trading happening in these environments that we know are fragile.
And that creates a really dangerous feedback loop. That low volume crash we talked about on Blue Ocean at 4 a.m. that generates real immediate news.
It creates headlines. Tech stocks plunge 5% in overnight trading amid Asian sell-off.
Exactly. And that headline, even if it's based on this conditional, soon-to-be busted volume, it's a real headline. It gets scraped by news feeds, by trading algorithms, and most importantly, by institutional portfolio managers who are just waking up.
And I get spooked.
They get spooked. They don't have time to do a full forensic audit of where the volume came from. They just see big red numbers next to U.S. stock names. So they might pull capital, they might hedge their own positions, or they might just start selling on the NYSE Open at 9:30 a.m. purely because of the fear and volatility that was reported overnight.
The simulation effectively crashes the reality.
That's it. The tail is wagging the dog. But the tail is now made of this inherently conditional and unreliable data, and it's steering the whole market.
So let's try to pull all of these threads together. We started with this really appealing promise of a 24-hour market, and what we've actually uncovered is this parallel structure that is, well, deeply vulnerable in a crisis and carries these really profound asymmetrical risks for the individual user.
I think the key takeaway just has to be repeated. The 24-hour market is a financial fiction. It's a side-loaded simulation of the real national market system.
It's convenient when things are calm.
It's convenient in calm periods, sure, but it fundamentally lacks the robustness, it lacks the regulatory protection of the CEE rules, and most critically, it lacks the absolute guaranteed finality of the official system.
And the lesson from August 5, 2024, is that all that speed and convenience comes at the cost of security.
It absolutely does. The simulation comes with that time machine clause built right into the fine print. If the technology breaks when you need it, the operator can just reset the game, erasing your successful exit and forcing you right back into a losing position.
Finality is an illusion.
It's an illusion. It's an aspiration that gets revoked at the exact moment it matters most.
And if we connect this to the bigger picture, I mean, this trend isn't slowing down. As Robinhood and the other big players keep pushing more and more assets into these 2047 environments, the regulatory silence around these price islands just feels more and more alarming.
Regulators have to address this. They have to address the structural asymmetry, and urgently. These ATS venues aren't just some niche pools for professionals anymore. They're major pipelines for retail orders. And we've established in these places, liquidity can be a phantom, and finality is conditional on server uptime.
So marketing them as if they're equal to the real market is just misleading.
It's misleading and it's fundamentally dangerous.
So what does this all mean? The final thought that I'm left with, really, based on this deep dive into the contractual loopholes and the counterparty risk, it goes back to the institutional players like Jane Street. They're providing the liquidity that makes the simulation work at all.
Yes, they're a necessary component.
Okay, so given the regulatory asymmetry we've dissected, where the ATS operator can just void a trade because of system failure, what recourse does a retail investor really have against a sophisticated firm like Jane Street that successfully matched a trade with them during that collapse? I mean, the institution's trade was matched. It was recorded on Blue Ocean's ledger. They profited from providing that liquidity. But the retail person's exit was just unilaterally canceled hours later. Doesn't that inherent contractual risk mean that the small user is just always left holding the entire bag when the simulation fails? while the professional on the other side has either already hedged their risk or just keeps their position, totally unaffected by the time machine being activated for everyone else.
That is the ultimate question, isn't it? It's about conditional finality and risk transfer. And it highlights exactly why the regulatory scrutiny needs to focus not just on the technology, but on who is actually bearing the counterparty risk when the system inevitably buckles. Because if the rules allow one party to just erase their transaction, but force the other party back into their original losing position, then the structure itself is fundamentally unfair.